This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
If you're just now joining us, in breaking news, U.S. regulators for the first time approving ETFs that invest directly in Bitcoin. This is a move heralded as a landmark event for the roughly $1.7 trillion asset industry, the digital asset sector, that will broaden access to the largest cryptocurrency on Wall Street and beyond. The SEC, whose three-part mandate includes investor protection, authorized 11 funds to begin trading on Thursday. Let's now go to Carol Massar, who's standing by with Cathie Wood, the CIO, CEO, and co-founder of ARK Invest.
All right. So, Cathie, what do you think about in this moment of time? As we said, this has been long in coming.
Yes. Well, you described two ways this could happen. It can happen very quickly, or will it happen very slowly? When you're talking about institutions that have been very fearful of this space because of Gary Gensler and all of the drama. I think they're going to tread lightly. I don't know if you saw, but Gary Gensler put out a piece today, right as we're about to go effective, and I'm sure we all went effective roughly around the same time. And he just denigrated the whole crypto space. And I was just like, I couldn't believe it. So anyway, it's with that kind of trepidation that institutions are going to have to, work through and do all of their due diligence. However, I do think that a lot of investors have considered, have been curious, and you'll see we've been, from a marketing campaign, we've been using this tagline, "Aren't you a bit curious?" There are so many people who are curious out there. Of course, a lot of our existing clients know all about Bitcoin because we have owned it since 2015. But there are a lot of people who really have a hunger to know, and we can see that as more and more people read our research, tune into our Bitcoin brainstorm that we do with Rod and Bitcoin Park in Nashville, Tennessee, read our Bitcoin monthlies, and read all we have to say about crypto in blogs and in our brainstorm summary. So, we are getting all the curiosity. I think that's why we started. So we know a lot of people are waiting, and believe it or not, Carol, the curious extend to state pension funds and state treasurers we're talking to. So it's a really broad swath of people.
And I do wonder what you think success will be out of the gate in terms of investment flows. What's your hope, what's your goal or estimate in terms of bringing investors into the fund?
Well, it's very interesting. I was speaking to Eric Balchunas, your colleague, and according to his estimates, there's $4 billion waiting, in the wings. And I said to him, well, from your lips to God's ears, that would be amazing. And, we hope we get our fair share of it. I mean, we've certainly done a lot to educate the community. And we experience a lot of gratitude for that too, from the innovation communities, including the Bitcoin community, but also from the financial community, those who really are trying to find the next big idea. The old guard, basically throw out there all kinds of risks, and some people call it fear, uncertainty, and doubt. It happens every time, Carol. And I'm not saying it's a bad thing for people to really do their homework. They should do their homework. They should understand the risks. But this is par for the course in disruptive innovation. And thank you, Carol. You gave us our first interview, 2015, when we were barely off the ground. You believed in us back then. And at the time, you remember we were talking about Tesla.
Mm-hmm.
So much fear, uncertainty, and doubt, not even about autonomous, which is the next set of fears, but about EVs. And wouldn't traditional auto manufacturers absolutely choke them to death? This is completely new DNA. And so it's the old DNA, as the old car companies were, the old DNA, basically bashing the old new DNA. But
Right.
truth wins out. Truth
But
wins out. Better,
let
faster, cheaper, more productive. So,
Yeah. And one thing I wanted to ask you is, as like yourself, all of us here in the newsroom, watching just, new things come into the market over decades. And this is certainly interesting, but we are still wondering about the real case use. I mean, that no one has really demonstrated a real life use case when it comes to Bitcoin.
we think about it all the time. Our first paper, white paper, was all about, could Bitcoin serve the three roles of money: means of exchange, store of value, unit of account? Most people are thinking store of value right now. But I'm going to plug one of our Bitcoin brainstorms. If you want a mind-blowing experience, and I am lucky to be able to ask questions on these brainstorms, but we had, I think it was either our second or third brainstorm, which was about the convergence of Bitcoin and artificial intelligence.
Mhm.
And we had on people who are, toiling to make all of this happen. One of them, a roast beef from the Lightning Network or Lightning Labs. And I have to tell you, what's going on in the emerging markets and the division of labor, the redefinition of labor, a little bit like what happened to the gig economy here, but
Mhm.
put that on steroids. It's already starting to happen. So I would highly, highly, highly advise anyone interested in trying to figure out how the world is going to work.
Right.
Listen to that Bitcoin brainstorm, because it's already starting to work in the emerging markets where they need it so desperately.
Cathie, what's the advantage of the ARK spot Bitcoin ETF over the others who also got approved today? We've been, as you know, reporting a lot about this kind of war on fees. Again, today, you guys cutting your fee. So what's the advantage of going with you versus a BlackRock or a Fidelity or some of the other players who are out there?
So at least three advantages, Carol. First, we selected our partner very carefully. 21 Shares is the largest pure play crypto ETP provider in the world, with $2.5 billion in assets. So what does that mean? That means with their 40 funds, before we launched with them, with their 40 funds launched over 5 years, they have battle tested their infrastructure over booms and busts, over crises, over halvings, over forkings. This is not normal for the ETF world. And we think the other ETF providers have a lot to learn. And I'm sure they are, and they will, as we go through, these different kinds of experiences. And they have economies of scale, believe it or not, that have enabled us to drive down our fees this way. We have more economies of scale because of the infrastructure that 21 Shares have built out. So that's the first. The second is research. Both of us give our research away for free. Our research started in 2014. We were trying to understand the technology. And then when Chris Berniski took over, we fast forwarded into understanding Bitcoin as money and then a new asset class. So we have been taking our clients, prospective clients, anyone who wants to read our research,
Mm-hmm.
this journey with us through deep, deep research. And it's getting deeper under Yassine's leadership. So that's the second. And then the third, and this one is not to be underestimated, especially when it comes to the wirehouses like the Morgan Stanleys, the Merrill Lynch, the UBS, Wells Fargo. Our sales force, our distributor, Resolute, has had our ETF specialists have had to understand Bitcoin since we struck our partnership in 2016. I had a funny story. Rebecca Burke, who's our most senior ETF specialist, joked with me the other day. She said, "Do you know, when I was coming to interview to ARC, I looked up what is Bitcoin, and we all laughed about it because now she not only understands it, she believes in it. Her conviction is high. She's able to share that message and hold clients' hands when Bitcoin goes through some of the volatility that we see it go through regularly. So I think those three, we have the infrastructure and operations, we have the research, deep research, and we've been doing it longer than anyone else. And three, we have a support team, a sales team that I don't think anyone else out there can beat, because we've been doing it together for 7 years already. And the same for 21 Shares, more on the institutional side. They have been working with their clients for 5 years.
I want to remind everybody, we are, of course, on X Spaces. I'm Carol Massar of Bloomberg TV and Radio. I'm talking with Cathie Wood, ARK Invest founder, CEO, CIO, on a day when the SEC approves Bitcoin spot.
You're hearing a conversation that Carol Massar is having with Cathie Wood, the CEO, CIO, and founder of ARK Invest, talking all about the news today that the U.S. regulators have approved an ETF that invests directly in Bitcoin. Let's go back to that conversation.
Listing some of the concerns that could happen. One of the things we wondered about, Cathie, and I'm curious, I'm thinking people who are listening to this, what is the recourse if a custodian who holds the keys to Bitcoin loses them, or they're hacked? What's the investor recourse?
You know what? We have with us on this call Ophelia and Haney, who are the founders of 21 Shares. You're talking about infrastructure, operations. This is what I'm talking about. May I open up the floor to them?
Ophelia, you want to come in on that? You are a partnership, it's a partnership with you and ARK.
Absolutely.
What's your thought on that in terms of concerns that if something happens, if it is hacked, what's the investor recourse?
So people are completely right to be concerned. This is the whole point. This is not like stocks and bonds. This requires a very different level of infrastructure. And so I think the first step in this discussion is very clearly prevention. You need to build as robust of a setup as possible, and you need to battle test it. So we've been battle testing our implementations with custodians, our technical infrastructure, and the way in which we safeguard assets for 5 years. That's the entire point. You can't treat this like any other asset in the world. It's a bearer asset, and it's held in a very technical way. So one of the things that we do is we use a concept called cold storage. That means is that these assets are held offline in wallets that have never been brought into the internet. So you've never used them before, which means that the information related to the private key doesn't exist on the internet. It's sort of you can think of it as the diametric opposite of cloud storage. You essentially end up with, a private key that's been sharded. So it's been split into multiple pieces, and you need to bring multiple pieces online at the same time. Those pieces are held in vaults that are geographically distributed in order to control access to these products. And then we obviously have a really robust set of controls around that in terms of how you initiate transfers and how you actually move assets, because the most dangerous part of custody is actually very much the point at which you access it, right? Very frequently, when people say, oh, somebody took over my exchange account, the underlying wallet's not being hacked. What's actually happening is that their security and access protocols are being compromised in some way, not dissimilar from certain social media issues, which might have happened yesterday. And so it's really important how you actually secure these assets, and why you need to go with a provider that's actually has a track record of doing this and knows what they're doing through a variety of market conditions, because this is actually a very, very technical space.
Appreciate that. Ophelia Snyder, co-founder, president of 21 Shares, and of course, offering up the Bitcoin ETF with ARK Investments. Cathie, one thing I also think is concerns about the price of Bitcoin, the volatility. The last 3 full year returns were gains of 305% in 2020, up another 60% in 2021, followed by a loss of 64% in 2022. It's a market that can move around. We saw a little bit of a pop in Bitcoin. Will volatility continue to be a risk or something that investors have to be very much aware of? And I'm curious, what is your price forecast at this point now that you've got the SEC approval for Bitcoin?
Sure. A couple of things. So the volatility, this again is natural for disruptive innovation that is really taking market share in any market. So it's normal, Carol. You've seen from our fund how disruptive innovation can be affected by exogenous factors that don't have anything to do with the share they're actually gaining. In fact, we know that during tough times, innovation gains more traction because it's better, cheaper, faster, more productive, and so forth. And you saw this during the regional bank crisis. The regional banks imploded, the KRE index imploded. We saw bankruptcies, and Bitcoin shot up 40%. Why? It's a flight to safety. It is not. It will not be a victim of counterparty risk the way the banks will. So it's actually, as time goes on and we go through more and more crises, and it seems the way government spending and monetary policies go, that is not going to change. I think Bitcoin is going to prove its worth. One thing in terms of price, and then I'd like to just talk about fees because that's so controversial.
Yes.
So our price target, our bull price target, and I would say institutional money moving in makes our bull price target more likely now is $1.5 million in 2030. And you can see in our big ideas from last year at ARK invest, ark-invest.com, how the building blocks for that number.
Right.
Right. And institutional is one of the biggest reasons. In terms of fees, you'll notice 21, that's a very special number. First of all, those are our partners, 21
Right.
shares, but also 21 million units or 21 million Bitcoin will, that is the total number that will be printed or minted, right? It will not go past 21 million. This is called a rules-based monetary system. And so the fee, we thought that was clever, and we were going to start out with that one, but we knew what was going to happen, so we ended up there. But I want to bring back something I mentioned before. We already have the economies of scale that others do not because of our partner, 21 Shares. And so we've been able to negotiate down service provider fees in a way that we would not have been able to if we had done this by ourselves. And the other thing I want to emphasize is we are not looking to maximize profits with this. We are looking at Bitcoin as a public good. It is a financial superhighway, and we want to increase the access to Bitcoin. And one of the ways to do that is this low fee product. We have other actively managed strategies where we can do more on the profitability side. That is not our objective here.
Cathie, just one last question, and that I'm glad we got that in 30 seconds just to wrap up. I mean, what does success look for you guys in a year from now with this particular product?
Well, I think we will be a part of the success of Bitcoin broadly. I think this opens a new chapter for Bitcoin, and I would like to believe we will be within the top 3 or 2 top providers of Bitcoin through this Bitcoin ETF.
All right. And just lastly, as you know, I like to squeeze in stuff. 15 seconds. Is there new cryptocurrency products, ETFs, that might come out from you guys as well in the near future?
Well, we already put with 21 shares out 5 futures products. Those are
Right.
active strategy. One last thing I'd like to honor all of those who have toiled to make Bitcoin happen. Through this ETF, I want to reassure the community, the Bitcoin community, that self-custody and an ETF are not mutually exclusive. We want to see this ecosystem continue to decentralize, but we want to bring billions of people into the ecosystem. And this is why 21 basis points ARKB.
Cathie, I so appreciate you including me on this platform. Cathie Wood, ARK Invest founder, CEO, CIO.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right, everybody. So a recent story from our Priya Anand here at Bloomberg on how the demise of San Francisco's has been greatly exaggerated. She talked about kind of walking around and things weren't as bad as everybody's been talking about. She also noted that in the 12 months ending July 2023, the city actually gained 4,900 residents after also seeing some slight growth in the prior year, according to some new data that was out.
Yeah, some actually good data that was, it's not just anecdotal based on her experience there. Believing in this city, our next guest, who acquired the Transamerica Pyramid Center in San Francisco for $650 million at the height of the pandemic. Back with us, we got Michael SHVO, chairman and CEO of SHVO, a real estate owner, investor, and developer of unique and innovative luxury and landmark properties. Michael, good to have you back with us. How are you?
Thank you.
Happy New Year.
Happy New Year. So let's take a step back and just talk about your history in San Francisco and how it came about that you found yourself at the height of the pandemic acquiring such an iconic building in the city.
Since my business is really focused on owning, operating super prime real estate, when the opportunity came about to acquire the Pyramid, it was not really a matter of time. Having these type of opportunities are once in a lifetime. I'm the second owner of the property after the original owner, Transamerica, which built the building as their headquarters. But when you buy building for 50 years and not for 5 years, you're not really concerned about the little bumps in the market. Everybody sees black when it's dark, and they see light when it's light, and that's really not the time to buy real estate. I took quite a large bet, not only on San Francisco, Chicago, Miami, LA, all through COVID. We bought around $5 billion of real estate through COVID, and a lot of office buildings when there was a notion that people are never going to come back to work. Obviously, that was another demise that was
Why did
greatly
you feel
exaggerated.
confident that you thought, well, you know what, that's not exactly going to happen? Or is it a case that you just bought top tier properties that that for the folks who were coming back to work, that's where they were going to want to be?
I think you hit both nails on the head. But the first notion is that people are not meant to be alone. When you walk here to the Bloomberg's offices, I mean,
pretty cool stuff, right?
Cool stuff, and everybody's together, and everybody's sitting together and want to be together. The idea of working from home in your pajamas on Zoom is not sustainable, and that was my initial bet. The San Francisco idea was again a city that took a big hit through COVID because of tech issues. These are the first companies that work from home. But in San Francisco is a resilient city. It's a city that constantly reinvents itself, and the boom in AI right now is unbelievable.
It's one thing I was going to think about, Tim, because I know we've had a lot of conversations about work from home. If you talk to a lot of the West Coast tech companies, they're like, we were already working from home. We were already flexible with how we worked. So I almost wonder that maybe the impact wasn't going to be as strong. I don't know.
Again, there was a mental impact because it became not just a tech thing. It was there was a conversation that office is obsolete, right? And that obviously ended up being nonsense. And we're seeing today. I mean, our New York offices on Fifth Avenue are fully occupied. The Pyramid is renting at 2.5 times the rent that it rented pre-COVID. So not only people are coming back. We're just completing a $400 million renovation there.
Who's coming back? What type of tenants?
VCs, financial services, law firms. You're seeing really the gamut, but the pyramid specifically, these are leaders of the industry, right? It's a building that was built for built for the future,
right?
And that's the type of tenants that we're getting there. But it's also now become the center of San Francisco. This is what San Francisco believes is going to be the next thing that's going to rejuvenate downtown. And when you walk the streets, I believe you were saying, you walk the streets of San Francisco, it feels great. You feel the energy. I just came back a week and a half ago. You feel the energy on the street. That's something that obviously through COVID didn't exist.
Where in your portfolio around the country are you seeing the highest vacancy rates?
Again, it's not a fair question because we have really high occupancies because we only own trophy assets. In the trophy asset category, vacancy rates are quite low. I mean, if you look at San Francisco alone, right, vacancy rates in trophy office buildings are 7%, while the entire market is in the 30s. So,
and New York has similar issues with many office buildings.
Every market. And I think I when we spoke last, I said this. There's this notion of converting bad office buildings to residences. It's like taking, I remember I told you, it's like taking bad milk and making milkshake out of it. It's still going to be sour milkshake. It's never going to work.
So what makes an office good in 2024? Because it's not the world of 2019 anymore. There is this hybrid work environment. Even if you have a return to the office, you're still doing a lot of Zooms. You're still doing a lot of teleconferencing. Not everybody's going to be in your meeting. What's different about an office space in 2024?
Let's start by the fact that you're asking the question. That's already what's different. The difference is that now we're actually thinking about our office. When 5 years ago, before COVID, you would never ask me what's the new thing about office. Why do people come to work? It was just natural. Let's put people like little fish in a cubicle, and that was basically it. Now we understand the same thing that we've been doing in the residential side and in the commercial side, that people actually care about where they work. Your lifestyle at your office shouldn't be worse than it is at your home. And that's kind of what we've been doing. So what we've been focused on doing over the last decade is really transforming the office space to be as similar as it can to your home environment, as far as services, as far as in the environment, the air, the luxury, the services. Your office is a great example because it's where people come to collaborate. So you have the spaces where people can collaborate, open space. You have the closed offices where they can Zoom, but these are flexible spaces. It's not one size fits all, which was the traditional office kind of pre-COVID.
Hey, Michael, one thing I wonder, do you think, we talk a lot about the rate environment and obviously what the Fed's going to do. What are your expectations in terms of rates? And obviously a lower rate environment is good for folks in the real estate world. So how are you thinking about it and how it might shape some of the activities you do here in 2024?
So again, I think that as some of your previous speakers said before, I think there's obviously an expectation that rates are going to go down. I'm looking for the crystal ball here at the Bloomberg headquarters of how much they're going to go down.
Show me where you find the crystal ball.
I don't know. I'm asking you.
Okay.
It's locked away in the U.S. Central Bank safe.
But I think that there's definitely consensus that they are going to go down. How much we don't know yet.
Yeah.
But
will it shape what you do this year?
Well, look, I think from our point of view, because part of what we do is we're partners with a lot of the German state pension fund insurance companies.
Yeah. And
we buy long-term real estate. We'll buy in cash, we'll buy with debt. Obviously, with debt, we'd rather buy real estate with debt if the debt markets allow it. But we're first and foremost focused on finding the right trophy assets. So that's why I said when I bought the Transamerica Pyramid, it was in the midst of COVID. We still ended up buying it. So interest rates are gonna move the market,
right? And
I think what the more important thing is that they're going to open the debt markets, which were fairly static over the last 3 years.
Talk to us about New York. You've got a property, right? 685 Fifth Avenue here in New York.
We got so in New York, again, like in most markets, we develop high-end residential. The Mandarin Oriental Residences that was just completed. We just opened an amazing private restaurant with Daniel Boulud there. Lots of fun.
Love Daniel.
At the rooftop, love Daniel. He just opened Cafe Boulud, which is also amazing. We're opening one in Beverly Hills with him. So that property is really geared to making people's lives better. What does that mean? you're buying an apartment at the Mandarin residences, and you don't even bring your toothbrush because Mandarin will give you everything from your slippers to the robe to the toothbrush. And then we have our office portfolio here. We own 711 Fifth Avenue. We own the Amana in New York, 530 Broadway. Office buildings that we have, severely kind of upgraded and 711 Fifth Avenue, again, fully occupied building today. Core Club just came in there. Raffles just came in there. So really, Allen and Company, one of the folks in your world, are headquartered there. So we've created really an environment of a high-end boutique office building designed by Peter Marino, which is fully occupied in a market that, again, is not, on averages, is not showing those returns.
I'm going to squeeze something in. My producer's going to have a heart attack, but you got 15, 20 seconds. Is the idea of transforming office into residential, can it be done, or is that
very, very selective? The building has to have the right bones in the right location, the right ceiling heights, and the right windows.
You were quick, and you saved Paul's heart. Thank you so much. Michael SHVO, Chairman and CEO of SHVO, real estate owner, investor, developer of innovative luxury and landmark properties, joining us right here in our Bloomberg Interactive Broker Studio. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, something we talked about at the end of 2023, the rally in emerging markets ex-China. The group up 17% in 2023, add in China, and the gain was only 7% as measured by the MSCI indexes. So it's interesting. We know China was certainly a drag on the global economy and also certainly on the investment landscape.
Well, our Drive to the Close guest certainly has some thoughts on emerging markets. Alison Shimada is Senior Portfolio Manager and Head of Total Emerging Markets Team at Allspring Global Investments. Alison joins us on Zoom from San Francisco. Alison, good to have you with us this afternoon. As Carol noted, not all emerging markets are created equal. How's the outlook for the category in 24, and where do you think investors this year specifically should be putting their money?
Mm-hmm. Well, thank you, Carol and Tim, for having me. I think there are very solid opportunities in the EM. I think it has, really been ignored for quite some time. And I think in three respects. Number one is that it's somewhat under-owned by investors globally. Number two, it's underappreciated for all the opportunities we see in individual countries. And number three is it's really undervalued versus particularly the U.S. So only selling at about 11.7 times PE and 1.6 times price to book. So, we see opportunities here at the beginning of the year. We particularly look at growth and income, and we see a lot of dividends that can be paid. We see strong companies. And in terms of the areas we're focusing on, really, as you mentioned, countries ex-China are interesting to us. India, Brazil, South Korea, Taiwan. There are quite a few of the larger companies are quite promising this year.
Hey, one thing I do want to ask you, and we appreciate you laying out where you do find interesting opportunities, but I do want to talk about China because our folks in our team have been talking about how China is the contrarian trade of 2024. I mean, people don't like it. When we talk to people, they're like, no, we don't want to commit new money. And to me, when everybody's running from something and something's been an area of the investment landscape, global investment landscape has been beat up, to me, maybe there is some opportunity then. So
I totally agree with you. Yeah, no, that is absolutely true. We have been investing in China for the better part of 25 years, many of us on this team, and have seen it since it opened. And, I think that there have been many crises in China. However, I think that there is with selectivity and proper stock selection and a history of understanding these companies and the policy, one can properly invest in China. I don't think it's to be entirely avoided, but I think you need to be selective. And until we understand the intermediate term, the longer term objectives of the country, it is somewhat of a trading opportunity. But we certainly have, we are underweight China, but we do have quite a few holdings in China, and not only in the industrial space, but in the financial space, and somewhat limited to in the consumer space as well.
What do you think is the biggest risk in China right now? And do you think that the country can get beyond that?
Yeah, I think that one of the biggest risks is just not doing enough and not staying the course in terms of reopening and supporting industry.
Do you mean not doing enough in terms of government support?
Yeah, I think that they have done some policy that has been supportive, but it's been here and there. Unlike the U.S. with the Inflation Reduction Act very early on, I think that was a very effective policy because we got it out there, started working on it, and now you see some very positive effects of that. I think China has hesitated a bit on the policy and had hoped that they could just, make it through the difficulties of the property industry. But it's a very large scale, and I think that has to be addressed. And I think that the markets are lacking confidence. It's really a sentiment issue. I think that overall the country is okay. Policy with regards to property will take some time. It's going to take a lot of time.
Do you think we get back to a point where, the S&P 500 has been an incredible force over the last decade or so.
Absolutely.
Yeah.
Do we get to a point where emerging markets start to hold a candle? Even at 17%, if you exclude China, emerging markets underperformed the S&P 500 last year. Again, do we get to a point where the emerging markets as a whole outperform large caps in the U.S.?
I really hope so over the next few years. And the reason I think so is for the three reasons that I stated earlier on. I do think that the 45% discount of emerging markets overall to DM is too big. And, everything's like a rubber band. It eventually kind of goes back the other direction. I think it's purely a sentiment issue. There's a very strong home market bias on the U.S. People do not want to give up on it, despite high valuations, and they're just hesitant to go overseas. But I think if the dollar starts to roll over, which I think, it peaked in October.
Right.
That's going to be the minute the dollar rolls over, it's going to flash a green sign, and people will have to look for other forms of returns in other places. And it's not necessarily China, but it could be in other countries in EM.
Hey, listen, just got about a minute left, and you actually had, shared with our producer, Paul, some names that you find interesting. Just pick one that you think global investors should have on their radar.
Yeah, I think Bajaj Auto is a very interesting name. It's India, the largest two-wheeler and three-wheeler producer in India, and they have had very strong earnings. It's a great group, an industrial group, Bajaj, and I think that it's a play on the rural space in India as well. But the overall economy in India is a multi-year growth story, as I think most investors understand now. But we really see it as a very strong player in the market, and it has a 3% dividend yield as well. But
you got to buy it in a fund, right? Because there's no ADR here in the United States.
Correct. Yes. Many of these names, and it's true for India overall.
Right.
Not a lot of them have ADRs, but there are some of the larger names, for instance, the banks or the enterprise hardware or software companies. They do have U.S. listed.
I have to say it's refreshing to talk about emerging markets. I feel like a few years back, and whether it was a Mark Mobius or somebody, you would just talk about it constantly. It kind of took a back seat as we've really focused, certainly
totally taken
some
a
of the
seat.
Runs, right, that we've seen in like U.S. big caps and the indexing. Alison Shimada, thank you so much. Senior Portfolio Manager, Head of the Total Emerging Markets team over at Allspring Global Investments on Zoom in San Francisco.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.